Imagine placing a box of treasure in someone else's care, trusting they safeguard it, but also secretly hoping that it somehow multiplies when you return to claim it. That's somewhat the ideal scenario when you deposit your hard-earned money into a bank. Most people perceive banks merely as financial safety vaults where the cash reserves stay static until withdrawn. But what if this storehouse of yours does more than just guard? What if it puts your money to work, dipping into a myriad of operations, some of which are fraught with legitimacy questions and ethical quandaries? Banks aren't just inert containers for our money. They are dynamic, operative beasts thriving on customer deposits, generating profits through a spectrum of complex financial maneuvers. The concept that banks simply store your money ceases to exist in the real world. What happens when you deposit money? When you deposit money into a bank, you're essentially granting the bank permission to use that money in a way that they deem profitable, under the promise that they'll have enough liquidity to meet your withdrawal demands. And that's what Big Buddy Dave Ramsey wants for you to get mucho casho. This might bring to mind a startling query. Is all of your money actually there in the bank? Surprisingly, the answer is no. Only a fraction of all deposited money is kept on hand in the bank's vault or at the central bank. This is known as the reserve ratio. Majority of your deposits are cycled into an ongoing whirlpool of loans and investments. This transition from static cash into dynamic financial avenues is what keeps the banks operational and profitable. The real kicker is how this money is multiplied. Thanks to what economists call the multiplier effect, your bank is able to lend more than it physically holds, based on the premise that not everyone will withdraw their money at once. Loaning out your money. The banking multiplier. The concept of the banking multiplier might sound like a financial magician's trick, but it's a core tenet of modern banking. In simple terms, when banks receive deposits, they keep a small portion as reserves to fulfill withdrawal requests and lend out the rest. The surprising fact here is that these loans then get deposited in other banks, creating further deposits and loans in a chain reaction, magnifying the initial amount of money exponentially. Through this mechanism, banks do not just hand out your money, they expand it, creating credit and effectively increasing the money supply in the economy. This power to create money places banks at a critical junction of economic influence, but also under tremendous risk if too many people decide to withdraw their money simultaneously, a situation known as a bank run. In the film, It's a Wonderful Life, this very thing occurs, or are you too young to even know the movie? Understanding this risk brings forth the importance of regulations like reserve requirements, designed to ensure banks keep a minimum amount of your deposits on hand to prevent potential crises. Investments. Where do banks really put your money? Your deposited money doesn't just lie around, banks invest it, sometimes where you least expect. Common outlets include mortgages, personal loans, and business financing. More intriguing, however, are investments in foreign currencies, government bonds, and even the stock market. Navigating through these financial territories allows banks to not only profit but to stabilize various markets and facilitate economic growth. Yet, the selection of investments raises questions about the safety and ethics of using customer deposits to potentially gamble in volatile markets. This leads to a broader discussion about the nature of bank investments and the inherent risks involved, which we will explore further in the ethical dimensions of banking practices. Fees and miscellaneous earnings, a hidden minefield. Apart from loans and investments, banks generate substantial revenue through various fees. Overdraft charges, account maintenance fees, and ATM withdrawal fees, to name just a few. Here's an interesting fact. Such fee revenues can form a significant chunk of a bank's non-interest income, contributing to their financial robustness. For customers, however, these fees often come as an unpleasant surprise, pecking at their finances. The lack of transparency and the perceived unfairness in fee structuring lead to criticism against banks, questioning whether such practices are more profit-oriented than consumer-focused. Understanding the complete landscape of bank earnings beyond the primary loan and investment operations is crucial in recognizing how banks balance between profitability and service. The ethical debate. Are bank practices in your best interest? The operations of banks raise a slew of ethical concerns. While banks are in the business of making money, the manner by which they do it, and at what cost to customers, remains a contentious issue. Are the interests of the depositor genuinely aligned with that of the banks? Consider high-risk investments or aggressive loaning practices that might jeopardize depositor money. Further, transparency issues and fee structures might prioritize bank revenues over customer needs. This ethical landscape makes many ponder if banks truly operate under a fair, equitable model that balances their profit motives with customer safety and satisfaction. Engaging in this ethical debate encourages a broader discussion on how banks could better align their practices with the interests of depositors. Consumer protection. How safe is your money? Given the revelations about how banks utilize your deposits, you might wonder about the safety of your funds. Banks are regulated entities, and measures are in place to ensure that your money is protected up to a certain limit. In the United States, for instance, the Federal Deposit Insurance Corporation, or FDIC, insures deposits up to $250,000 per depositor, per bank. This insurance acts as a safety net, protecting individuals from losing their money in case of a bank failure. Such regulatory measures are essential in maintaining public trust in the banking system. However, the extent of regulation and the effectiveness of these protective measures can vary significantly from one country to another, influencing the global perception of banking security. It is crucial for consumers to understand these protective frameworks and consider them when choosing where to deposit their money. The ripple effect. Economic impacts of banking activities. The activities of banks extend far beyond individual transactions and have profound impacts on the economy at large. The way banks manage deposits and generate loans influences economic growth, inflation rates, and even the job market. For example, by increasing the money supply through loans, banks can stimulate economic activities, leading to job creation and business expansions. Conversely, tight lending practices can slow down an economy, potentially leading to recessions. Understanding the economic ripple effects of banking activities helps elucidate the significant role banks play in shaping economic policies and their direct impact on everyday lives. Power to the people. Gaining control and knowledge. Knowledge is power, especially when it comes to managing your finances. The more you understand about what happens to your money once it's deposited in a bank, the better equipped you are to make informed decisions about your financial health. Empowering yourself with knowledge about banking processes, the safety of your deposits, the implications of bank fees, and the overall economic impact of banking practices enables you to take control. It also fosters a more transparent banking environment, where consumers can advocate for practices that safeguard their interests. In conclusion, banks play a crucial role not just in safeguarding our money, but in leveraging it to fuel economic engines. By understanding the multifaceted roles banks play, consumers can better navigate the financial landscape, ensuring their interests are protected while contributing to a healthier economic ecosystem. Engaging with these revelations not only demands a rethink of our interactions with banks, but also grants us the ability not to get roasted by Caleb Hammer.